It was a year ago today, a market collapse. It erased nearly $900 billion in value from stocks in less than 20 minutes. Regulators still cannot agree that it won't happen again, or really what caused it. So what can be done to ensure against another market plunge that in the vernacular is now known as the flash crash? Well, my guest is Joseph Cangemi. He's a managing director and head of equity trading at ConvergEx Global Markets, and he's also a board member and treasurer of the Security Traders Association. Joe Cangemi, good to have you with us on Bloomberg. Where were you when the market plunge took place a year ago?
I was standing behind my trading desk, actually monitoring the conditions for the day. It was actually a very, very difficult day for the markets. I like to explain the day as more of a perfect storm in the financial markets. Quite frankly, the macroeconomic conditions of that day were extremely negative. They were bearish at best. We had a lot of media showing what was happening in Greece that day, and it was causing a definite negative sentiment in the marketplace. So throughout the day, I was monitoring the conditions with my traders standing there and watching the market start to capitulate a bit. I actually was experiencing some anxiety that I experienced in the past. I lived through the '87 crash. I was an active trader on the floor of the New York Stock Exchange at that time.
When you say you were experiencing a little anxiety, I mean, are you being diplomatic about it? Because, you know, traders are known to be a little bit emotional, particularly if you get them in the pits. But what was the reaction amongst the other traders?
Well, no, actually, I was emotional, to be perfectly frank. I told my traders to reach out to every customer. It was going to be a difficult trading day. I anticipated the markets would be down, actually, close to 500 points that day. I did not expect what we did actually happen to happen so quickly and so efficiently. It was rather dramatic and it was impactful. As I was saying, the macroeconomic side of this matched with what turned out to be weaknesses in our market structure and regulatory oversights that were truly never uncovered in the 2 years prior, which were, quite frankly, created some benchmarks for trading in volume and volatility that'll probably never be reached in the near future. That volume and volatility tested the markets very arduously during that period, and yet never did we have a situation like we had on May 6th last year. The market in and of itself has a mechanism put in place when we instituted regulation at MS called self-help.
Right.
It allows for an electronic market to continue to trade when an exchange or a trading center is having technological problems, allowing investors constant access to liquidity. With that, we had regulations that allowed for market makers to provide a stub quote so that they can maintain their status in the marketplace. None of these were ever affected in such a dramatic way prior to May 6th. We had this negative bearish condition where market volumes were tending to be more negative than positive. We had generally day trading type investment strategies, high frequency strategies that were getting very heavily weighted to the long side. They were starting to pull back from the markets. Order flow velocity was picking up very dramatically.
It's like a confluence of events.
It was what I consider a perfect storm in our financial markets. So with that said, the New York Stock Exchange had in place something that I highly recommended when I was down there, what's called a liquidity replenishment point.
What's that?
Which is a condition on the floor where they pause trading, they slow it down, allow for demand to catch up with supply so that you can more orderly move a market, the stock of a market, down in a more orderly price.
So you can see if there's even a bid there, right?
Correct.
I mean, something can catch a bid. Otherwise, there's just like an air pocket and it just sinks.
But what happened during the institution of Reg NMS was that when the New York Stock Exchange declared the LRP status.
What's LRP?
Liquidity replenishment point.
Okay.
in a particular security. It was like declaring self-help. As well.
And that almost is waving a red flag in front of investors saying, okay, we're going to have to go in and provide liquidity. Everybody then heads for the exit because they're worried about not being able to access it.
Well, but the other problem is that it directs order flow away from the floor of the New York. Archipelago had self-help declared against it during that period of trading because their velocity of response was slowing down, and other exchanges took that as they may be having some technological issues. So we basically took 2/5 of our major markets out of the liquidity equation during a period where the velocity of volume and orders was trading very, very dramatically to the downside.
Speeding up.
But it was all being funneled in the direction of the NASDAQ, BATS, and Direct Edge were the only exchanges left at that particular moment in time. And with the lack of bids on the book, there was actually that capitulation that we were almost anticipating.
There was no one to step in between.
Right. But the sell-side volume reached down to these stub quote levels, which created a stream of market data that created another stream of market data that said buy. These are buying opportunities, and you have the confluence of order flow coming back up through price points that were not really sellable. So there was not a book being built to contradict the response. So we had an 18-minute correction to a very, very, very steep crash.
And we still live with a lot of those consequences because regulators and investigators haven't really pinpointed exactly the cause of the big plunge.
Well, people have tried to find a scapegoat or a solution.
I mean, they pointed their finger at Waddell and Reed and some S&P futures trades. Joe, we were talking about technology and the role that computer technology has played in the market and how that has changed the way markets interact with buyers and sellers. Give us a little insight into what happened a year ago and the role that technology played.
Well, technology is our tool that we use now to interact with each other, buyers meeting sellers. We meet through an electronic medium. Historically, the floor of the New York Stock Exchange concentrated order flow and a human interaction between buyers and sellers in a physical pit.
Right, but that's moved off the floor of the, what is it they say, about 80% of the actual daily trades are now done outside, off the exchange.
Correct.
Upstairs.
And at one time it was the complete opposite. It was 80% were done on the trading floor. So, with that said, we are now expanding the trading crowd to an electronic format so that as a representative of a customer, we're interacting with the trading crowd electronically, using tools and facilities that expediently read market data that we gain from the marketplace and make decisions on behalf of that and send out orders in response to it.
So has the ability of human beings to monitor the situation, to monitor the market, kept up with the technology?
It's kept. Human beings have to direct the technology on how to buy and sell securities. It doesn't make the decisions on an order-by-order basis as they send them to the market. It needs to be there to keep the finger on the throttle. It needs to adjust the volumes, the sensitivities, and be constantly aware of the market conditions because they do evolve and change.
Now, you said you've been doing this for about 28 years, right? You must have started doing this while you were in short pants. And I want to get the impression that things have gotten a lot better in those 28 years. Have the regulators understood that, or are they going to continue to make and demand changes?
Well, the one thing I've learned in 28 years in the business is that it's always going to have a change. The markets have evolved from the day I walked on it. The day I walked onto the floor of the New York Stock Exchange, I was told, kid, why are you coming here? This place is short-lived. It'll never exist. I spent 25 years or so there.
On the floor?
On the trading floor.
What was your first position on the trading floor?
I was a clerk on the trading floor, taking orders from customers off the floor, basically from Chicago, from the options pit. I was one of the original options clerks, if you want to call them that, back in the day.
Do those jobs even exist anymore?
Yes, there are traders down on the trading floor. They're more sophisticated and knowledgeable than I was at the time. They have to be because they have to interact with the broader reach of the markets. Our markets are much more interconnected now, technologically linked and dependent on each other. With that said, May 6th showed that interconnectedness. The fact that the markets were bearish and in traders were using tools to electronically monitor their positions so that they would be more towards the sell side of the equation than the buy side was forcing a lot of volume into the markets, and the market structure did naturally handle it up until that point where we had that funneling effect.
How much panic was there on that May 6th?
I think traders, even in the market, the most sophisticated and experienced ones, took a step back and said, what exactly just transpired? This storm, this perfect storm that I've outlined for you today is very similar to how I felt on the morning of May 7th last year. It's actually the story I told that day about what I thought was happening. We had a funneling to a market structure and a regulatory response that didn't allow for bids to sufficiently move into the market quickly enough to counterbalance the supply. With that said,
it was like a one-way street.
Yes, but with that said, the industry, the regulators, the broker dealers, the exchanges all stepped together and created a variety of regulatory solutions to put in place after May 6th in quick response. We put in single stock circuit breakers. We eliminated stub quotes. We provided market maker obligations.
So you feel a little better about it all today?
I actually feel we've done a tremendous job in responding to what has taken place last year.
All right, we've got to leave it there, but I want to thank you very much. Joe Cangemi, ConvergEx Global, thank you very much for your insights and your personal history. Appreciate it.
Very welcome.